Hello, welcome. Thank you for being with us today. We're broadcasting live from Park City, Utah, San Diego, I think you guys are in, or California, somewhere in California,
Orange
and
County.
Orange County. And Brian, where are you?
I'm in Dallas.
In Dallas. That makes sense. You should be in Austin with all those guitars.
Yeah.
So, uh, thank you again for everybody for being here. We're super happy. Jeremy Littlejohn, my friend here in Park City, has introduced us to CNR Capital and Michael, Stephen, and Brian. And so this is the second opportunity for us to discuss the fund. We did it a few weeks ago, and so we're super happy to have you guys back. We're going to talk specifically about the fund and the raise and the ask associated with the raise today and more details thereof. So we can't hear or see you, but we know that you're there, and we super appreciate if you wouldn't mind posting questions to the chat box or the Q&A as they come to mind. We have a lot of folks coming on today, so we'll make sure we get to as many as possible. We're going to be recording this, and with you guys give us permission, we can post it on your website so people can review it and share it with others, which if there's others that you think would benefit from what you hear today, please feel free, and you're welcome to connect directly with CNR Capital and the principals here and share it with colleagues and other investors that might be interested in what you hear today. So feel free to do that. So with that, thank you again for being here. Thank you guys for doing this again with us. And Michael, you want to take it away?
Yeah, thank you again for having us. I'm Michael Roll, along with Steve Cotton here in Orange County, California. Brian Cantwell, as you said, is in Dallas, Texas. I'm the operating partner, Steve, the managing partner, and Brian is our CTO. So the beginning of this, we're just telling you that we're raising $25 million in emerging technology focusing on SaaS model companies in the AI space, renewables, and everything recurring revenue. So I'm going to take you through our model, which we believe is the key because it's so much different. So we're incubating new companies, new entrepreneurs that are coming to us with their idea. And so from the beginning, we're going to see the sweat equity. We're going to want to see their skin in the game. We're going to be matching up to 100 grand at the founders level. So whatever they're willing to raise, we are going to match them at the beginning. So we do see that skin in the game. We're seeing their idea being a big addressable market, something that is a big problem and an answer to that problem that is going to be SaaS focused. And then once that is proven up, we do our diligence on the addressable market and we like it. They're going to move on to the raise of the friends and what we like to call the friends and family round. So we're going to be willing to match them up to 250 grand. So again, they are going to have to raise their portion. They're going to be putting their own money on it. And so we're willing to match that. And then that will allow us to later scale into the Series A round if, when it gets there. But with these tiered step approaches to the investments, meeting the metrics that we want to see, meaning the addressable market at the beginning, then we're going to go through typically a beta period. So can work out all the kinks in the go-to-market strategy, the customers, any feedback that they have, everything gets in line with where we want to take it. And then we're going to be able to scale into the investment and go along with the entrepreneurs from the very, very beginning. And with that tiered approach, pretty much from all the feedback that we've been getting from our LPs, allows us to de-risk everything because we're not going to be just throwing a lot of capital at the beginning and the whole spray and pray aspect in a lot of investments. So we're going to be very hands-on, seeing how their product's coming along, helping them navigate every issue that comes along with starting your business and going from there. And to be able to do a little bit more of a deep dive, Steve and Brian, we're going to get into technical debt, and Brian's our CTO, so we're going to allow Brian to be on the back end doing his database expertise, and I'll allow Brian to go there to kind of give his piece about how we do that.
Are we gonna do Brian or Steve now?
Yeah, I'm gonna
Okay.
jump in. So the whole idea of the fund is this, like Brian and I and the team have actually worked together. We built other software companies. And one of the things you find is when software companies are being built, they typically go out, they raise some money, and they start coding away without maybe fully thinking through the go-to-market strategy, fully thinking through how the end customer is going to actually use the product. And so what happens is a product gets developed only to find out that you might have either a go-to-market issue, or you might have a technical debt issue, or both. So what we wanted to do was create a fund where we said, look, we want to end up with 40 to 50% of the equity, but we're going to go in from the beginning, and we're going to do a beta. And let me give you an example of what I mean by that. Well, in December, we sat down with a young entrepreneur out on the East Coast who wanted to create a product that would monitor perishable devices in both the food service and in the healthcare industry. Big addressable market. There are players in there. It's not been done well. And so we sat down with him and we developed an application in the cloud, highly scalable, very efficient in terms of using resources in a way that our cost isn't high. And we did that in 3 months. So in March, we went ahead and did a beta, and we said to this entrepreneur, in order for you to get our commitment into the next round, you have to take 85% of the beta customers and convert them into paid customers. And you got 90 days to do that. And so we did that. We got the customers' feedback. We saw some things that we thought would work, doesn't work, adapted it, changed it. By the time we got done with beta, we had 85% of the customers convert to paid customers. And more importantly, we had developed the website, the back-end store, the affiliate program, the application, all of it for under $100,000. So then we said to the entrepreneur, okay, great, we're going to go to market now. Now, I believe there's 2 different betas. There's a beta around the product, right? Getting the product right. But there's also a beta period in go to market. And what I mean by that is you have to know what channels, who your actual target customer is, who is closest to your customer that you want to sell to, and you have to build a go-to-market plan. And so we're in our 2nd month in what I call this next phase. We have targets set for the end of December that have to be met. The entrepreneur right now is doing about 120% of plan. We've gotten into customers that we never thought we were going to get into. And we will end up funding his growth round at the end of December. But here's what's going to be unique. Between the time the idea and the time we go to market, we will not have spent more than $300,000. So we've proven the product, we've proven the market, and now we take capital and we put it against that idea. Why is that important? Well, one, it gives us as partners the ability to get equity at the founding round, at the kind of scaling round, and then the early round. So we end up with much more of the equity, but we're also de-risking the investment so that when 80% of the capital that we'll ultimately invest in that comes in, we have already proven out those 2 pieces. That's what we're trying to do with CNR Capital. We're going to launch our next application October 1st. It's being coded right now. Same kind of scenario, huge market. And when I say huge market, multi-billion-dollar market, one where you could potentially grow that opportunity into a unicorn. And again, it's the same thing. 2 young women had an idea. They're putting up capital. We're matching capital with them. And we'll go through that exact same process. And that's really what we're trying to do. So we think we're unique in that, unlike other funds, we actually have a history. In my case, I have over 20 years history as a CEO of software and technology companies. I think Brian's history is much longer. The team's history as a whole is much longer. And we think this provides the investors a very unique opportunity to get into an asset class early versus later, where in some cases there can be greater risk. And Brian, I don't know if you want to comment on it, because you and I have both worked on this kind of stuff together from your point of view on the technical debt side and what you see.
Sure. So, I mean, you hit the main points. It's really a matter of taking a new company and not letting them do what traditionally, or what in the past we've seen, the raise 2, 3, 4 million, 20, $30 million, a really big raise. They'll hire everybody that can fog a mirror, right? So that you get a figurehead CTO, and you get some people that really perhaps they just, frankly don't know what they're doing, and they've gotten the position, but it's figurehead, right? So what we're trying to do is to get to the point where we've purposefully designed an application, or how they're going to do their business, so that we're not going to code into a corner, as Steve said. It's really a matter of having an alpha and beta stages, and testing and talking to the market, and not just go out there and code towards everything, all the catch words and all the fancy new things and such that could be done, and end up with technical debt, right? You use the wrong kind of database, the wrong kind of back end. You're not building an MVC or a model view controller style, or it's too monolithic, or it's too divided up, or whatever it is, right? So it depends on how these things work. So what we're going to try to do is to catch them in the stage where we can help to advise in that area. And I think that and as we've done in these, the two that Steve's mentioned, kept it within 100 grand or so, phone app included, development included, everything else, right? Because we've really paid attention to getting an MVP, or minimally viable product, to a beta stage, to where you can find out from the end users more so than from just people who are bringing this up out of their own head, what's really important. Because you may think it's the best idea in the world of certain features in your product, and perhaps the end users don't even care, or you're really missing the mark on something. You're close, but you're not quite there. So get an MVP out, get it in some people's hands, and let them take it from there, and advise you from the field and from the market what's really important. So
yeah, and Brian, to that end, one of the questions I get asked, people are saying to me, why aren't you guys trying to raise a 50 or 100 or $150 million fund? That's not the idea here. The idea is to do what we're doing. It takes a hands-on approach, takes a lot of hard work with the entrepreneur. So we're going to probably do 8 to 10 of these deals. So it begs the question, well, what happens when the entrepreneur is really taking off and needs to raise 10 or 15 million? Well, at that point, I think that gives us an opportunity as LPs and as partners to ask the question, which is, you know what, do we roll our interests forward, or do we simply get recapped out in that round and get the return that we want as partners, right? That's what we're trying to do. And if we were to try to raise 100 or 200 million or something like that, and try to get that deployed, what would end up happening, in my humble opinion, is that we wouldn't be able to do the work that we're doing, that I think is going to create huge strategic value for our LPs. So it's just a different approach, but that's the rationale. So I want to be clear here. When we talk about getting involved with these entrepreneurs, we're doing everything from helping them get the code done, to making sure they've thought through the front end, making sure they've thought through the go-to-market after the product is viable, to Brian's point, and we've actually generated revenue. So that's the reason for the 25 million. As Mike already said, this is, as you would imagine, we're only going to be using preference instruments to make these investments. And just so it's really clear, when we invest at the founder round and the what I'll call friends and family or scaling round, the fund will participate in each one of those, meaning us as partners, we're not going to be the only ones investing at that level. So you get the benefit, and there's no conflict because all of our interests are 100% aligned as partners.
So is it fair to say that this somewhat flies in the face of the typical venture fund? I shouldn't say typical. A lot of venture funds have been criticized because they throw a lot of money at the entrepreneur. They flush 80% of the companies, and with the hope that the unicorns are going to pay for all those sins. And if for the example, doing the math, because you're going to be able to participate at a higher percentage of the company in that early time, that if you had $100 million fund rather than 25, have you done the math to suggest that you're going to be able to have more of the follow-on round than you otherwise would if you had such a big fund, right?
Yeah, excellent question. So just for the audience's knowledge, I have raised a lot of private equity capital as an operator. I've also worked for a private equity fund. And to me, the most successful private equity funds are those that have really good discipline on helping the entrepreneur scale it. And the two companies that I can think of, there's one in San Diego called JMI, who I think has done a great job. And I have a friend of mine that has done one out in Boston called OpenView, that they've done a good job. But they had to build a very large organization where they're providing the marketing, they're providing, technology resources, et cetera, et cetera. So we know, and there are models that works. What we're saying is that our model is a little bit different in that those two companies I mentioned, for the most part, would want to invest at a later stage. Now, in fairness, JMI, I don't know if you guys know this, but ServiceNow, when that was founded, they gave the guy who founded Peregrine a couple $1 million, put him in a basement and let him go to work and code. And of course, ServiceNow has been a great success story. Everything that I've looked at over the years, that if you get in early and you do it right, and it's a big addressable market, the number of exit opportunities are greater for you. If you over equitize a young company, then it either becomes dead money if they're not successful, or you can't exit and still make money. So our idea in this is we're not trying to hit it out of the park. For example, we'll end up with Secure Temps. That's the company I talked about that does the refrigeration monitoring. We don't need to get a $200 million exit in order to make a great return for our LPs. We get an 8 times money return by just exiting at $42 million in that company, right? And so then you kind of look at that and say, well, if that's a big market, what does that mean? That means there are other people out there that'll potentially buy the company. That means there's other people that would maybe do a private equity round at a much higher valuation and let us participate, getting the LP's capital back to them, getting them their preference return, and then maybe we decide that we want to roll that with the new group. I just think it gives us more opportunities, gives us more control over the direction of the business, and then most importantly, I think, is it gives us an opportunity to help the entrepreneur be successful. It also gives us an opportunity, and I know this isn't a financial deal, but there are intangibles. It gives us an opportunity to teach young entrepreneurs about how you build a successful business. That's why we're doing it. I mean, that's what we're passionate about.
Yeah, to piggyback off of that, you see so many times, especially where the markets are at now, that the liquidation preference stacks are worth more than the valuations of the company whenever they come in at a later stage. So
it's a very good point.
Yeah, to piggyback what
the world
said,
has changed, right?
It's completely changed now. And with this unique approach, us getting in so early allows our minimal investments so early to be worth so much more at a later stage, as opposed to coming in at a Series B or a Series C much later.
That's a good point.
And then the valuations change if, from an investment perspective, you're posting revenue, and rather than guessing what the valuation is, you have a metric that you can assign a multiple to.
Right.
And that's an acceptable metric that people can, you argue about the multiple, but at least you've got revenue that you can
it's
scale.
validated by the market.
Yeah.
All these other comparable companies, we talk about it all the time. The SaaS model companies are pretty much being sold at the multiple of anywhere from 8 to 13 for the most part. So once we get those numbers and it's proven out, then there's really not much to argue.
Yeah, Brian, it's been said that a lot of the advances in technology have made it easier for entrepreneurs to do what Steve said. You have the beta and then the post-beta, right?
Right.
And so it's easier to go and build something that, 10 years ago would cost you $1 million, and you can adjust that when you find out what the customers really want.
Exactly.
And so has the Moore's Law, or whatever you want to call it, has that been truly exponentially easier to build stuff than it has in the past? And is it getting better?
It is indeed. So for sure, the tools, the capabilities, technology is grown by leaps and bounds since, the good old days. I've been doing this just barely shy of 40 years, from one method or another, or one stage or another, from, developing to leading. But for sure, the capabilities are there. I mean, the example is that we built one code base for the temperature monitoring company that we're talking about, for instance, that we could then the technology now exists to take that initial code base for the front end and turn that into not only your web application, but your iOS and your Android application all together, all at once, right? Whereas previously we would have built, the web-based portion for the front end, the back end's all the same, right? But for the front end, we would have built whatever type of a web application. Then we would have developers go and write the Android application, and then we'd had more developers or different developers go and write the iOS application. So now at this point, we did one code base and then used capabilities that exist now to turn it all into one thing, and saved, what would you say, Steve, from the estimates that we got, probably an extra $100,000 or give or take for the phone apps?
Minimum. It would have been, in my opinion, it would have been at least 100.
Yeah.
And more importantly, it's not just 100,000, it's the amount of time it takes to develop the product. And so, I mean, I would argue it's, going back to Arthur's question, you remember this, Brian, we don't have to deal with servers anymore, or provisioning storage, or any of that stuff.
Yeah,
right? It's so much easier today.
Things like using the cloud providers, AWS, Google, Azure, whomever, right? Instead of hosting your own database server on even if it's an EC2 instance or in a colo facility or something like that, use the hosted database instance that you get through Amazon or Azure, whomever, and let them worry about the SLAs. It's their throat to choke, right? For the uptime, right? They have to provide the 5 nines or the whatever, right? And so you're saving a heck of a lot of money and a heck of a lot of heartache because they'll scale it, they'll keep it up to date, everything else, and your code doesn't care where the database lives, for instance. And there's other examples like that, but for sure, right now the technology and the capabilities out there are such that you can really put out a quality product very, very quickly and not spend millions of dollars and hire dozens of developers. You really don't need to do that at first.
Yeah, Brian, I think the other thing though too that's probably important to note, and this is why we talk about how a product's architected, how it's designed, and how it's developed. I have an investment, actually Mike and I both do have an investment in another software company, and it's pretty cool what they do. But their AWS bill is close to $50,000 a month.
Yeah.
Ridiculous. Doesn't make any sense at all to me. But by contrast, the company we were just talking about, the way we architected it, we could get to our end goal by the end of December, and we won't spend more than $500 a month leveraging AWS as the platform.
Yep.
That's what I'm talking about. Like the people that haven't been around technology, they have a good idea, and I don't blame them. I get it. But they go out and they say, well, it's time to market, I got to do all this stuff. And the next thing they know, they're locked into a very expensive platform, and that money that could have went into sales and marketing and getting new channels set up, it's being spent on, the infrastructure and or the technical debt that's been created. And by the way, when I sat down and talked to that CEO, I'm like, what are you doing? Oh yeah, no, we recognize that we're going to re-architect it again. I'm like, you've already blown through $4 million, getting the app to here, and now you're going to re-architect it again, and then it becomes dead money.
It is. So you have to think about those things in the first place, because if you don't, I've had a saying, and I don't know if it came from my dad or somebody else, but if you don't have time to do things right the first time, when will you find time to do them again? Right. So you really have to think about what you're trying to do and how you're architecting what you're doing, because if you get yourself coded into a corner, as I call it, your technical debt will kill you. And so you really have to think about scalability. What happens when I take this? I mean, it's okay if at first you build something and it just works, right? But what about when you go 300 or 3,000 or 10,000 times what you are currently doing with your testing or with your beta group or whatever, right? What about if you really become wildly successful? How will it operate then? And you may be terribly disappointed if you really don't have those type of thoughts in your head.
Yeah, if you guys don't mind an editorial on Steve's comment, is revenue is cheaper than investor capital, right? So if you can build revenue from customers and not take investor capital in that costs you equity, then that's a better way to grow, right? And if you're spending $50,000 a month on AWS and you could have spent 10, that allows you to have $40,000 less that you have to call on for capital.
Yeah, I mean, you're absolutely right. And if you can get to $1 million ARR inside of 12 months, and again, what we try to do is work with the entrepreneur up front what the valuation is going to be at each stage at the very beginning. But you get to that $1 million in ARR inside of a year, and you were really careful about your capital in development and go to market, you're not going to burn through a lot of capital. Remember, the whole idea from our point of view is to take the last stage of the investment, right? The first stage is 100, the next one's up to 250, and the maximum's 2.5 million. When we get to that 2.5 million stage, we want to be as close to $1 million ARR, annual recurring revenue, as possible. And that in itself has its dynamics on valuation. But now what we're doing is we're taking the majority of the capital, right? More than 80% of it, and targeting a specific go-to-market strategy to accelerate quickly. And as you know, these companies do not have to get to 20 or 25 million ARR to get taken out at a high valuation. What they have to do is have a proven go-to-market, a highly scalable, growing monthly recurring revenue model, and somebody will take them out at a big valuation.
Yeah.
And that's the way it works.
Yeah.
And I've been, like I said, I've been doing this for years. And the biggest mistakes that I made over those years was, well, one was listening to people that didn't know what they were talking about. And two was probably the technical debt area. And so what we think we're doing here is we're giving investors a unique opportunity to work with seasoned pros who are going to incubate these companies against huge markets and know the right way to structure them so that they can maximize the return at the right point in time.
And flip the ratio, have 10% flush and 90% exit or whatever, right? Right.
And to your point, the ones that do flush, it's such a minimal investment at the beginning that it's fantastic model.
Yeah. And by the way, the one last thing I'm going to say that we didn't say, but I think it's worth saying. We have our own capital in this as well, meaning we're both acting as GPs, but we're also LPs as well.
Yeah.
You believe it.
Really important. Can we talk a little bit about the pipeline, deal flow, sourcing, that sort of thing?
Sure, you want to take a shot?
Okay, so with the two companies that we've talked about, obviously we're incubating them along. I was just out in New York City last week, meeting with the CEO of a company and their lead VC. So we have that. We're just working on the terms. So that deal could be any day now type of thing. That's going to be for 1.4 million. And we're just taking other pitches, working with other entrepreneurs now to start the incubation phase. And so we already have 3, well, 2, and then this one that I met with last week in New York City. So what looks like already 3.
Yeah, and then we're probably looking at 2 or 3 opportunities each week, right? I mean, the biggest thing for us, Arthur, is that when the opportunity comes to us, then we have to, really sit down and make sure the entrepreneur, understands what they're doing. And what we don't want to get into, like, we talked to a guy the other day that's trying to come up with an AI CRM product, which, on the surface sounds interesting. But, we dig into the valuation expectations, okay, I want to do a 15 million pre-money safe and I don't have any revenue and I don't have a product yet. Okay, great. Where do I sign up?
Yeah, right. Hurry up and send me the wiring instructions.
Right. So, I mean, I think what'll probably end up happening is probably for, I don't know, probably every 10 or 15 deals we look at, we're probably only going to end up doing one of them. I mean, I just, again, because the amount of time we're spending and really focusing on quality, I don't want to just try to say, okay, great, we got to fund this 25 million as quickly as possible. I would rather fund 22 million and be able to communicate back to the LPs. We did a great job with that 22. Sorry, we didn't deploy the whole 25, but we had great outcomes. I think that's what, the 3 of us are concerned with.
Yeah.
So I can't promise you we're going to do every deal.
And to kind of wrap up the structure a little bit. So what we're offering is an 8% accretion on the capital drawdown from our LPs, meaning once they send it to us and we deploy that. It's a very unique approach. I know you probably haven't heard it, so that's why we're doing it in tier stages. Obviously, we have a lot of experience between us 3 very unique operators. Have done this many times in the software industry. Deals already signed and then one looming on the table, which will be within a matter of days. So we're ready to deploy some capital, and we're in the middle of raising our $25 million fund. And as Steve said, we're putting in our own skin in the game. So it's really 24 million that we're raising.
So commitment, drawdown, 8% pref, 80-20 after. I'm just guessing at that number. Yeah.
Yeah. So it's our first fund. So we're not taking the 2%. We went down to 1.5%. And 80-20 after that with the 8% accretion pref.
Yeah. And me see if we got a question here. Given CNR's special efficient approach and focus on AI, how do you reconcile the rather capital intensive needs of AI companies? That's the first question. Specifically regarding GPU expenses, and it can greatly improve customer experience if a company retains generic models on a consumer specific use case. I can repeat that, or you can wing it.
No, I think I understand the point. So to me, there's two ways to think about AI. So if you're going to try to develop an actual AI platform, then I think the person that asked that question is absolutely right. It would be or could be capital intensive. On the other hand, what we're seeing is that there has been some AI developed that can be leveraged into applications. And that's really what we're looking for. So in other words, we're not going to try to do an open AI platform or something
Create
like
your own
that.
large language model and you know,
Doesn't make, yeah,
chunk it away. Yeah, all right, yeah.
yeah. It doesn't make sense at all. But even within our own organization at Secure Temps, the company I was talking about, we're leveraging AI within our site. And in some cases, we're looking at it now, leveraging it into the application, right? So, you know, for example, there may be an AI application or plugin that we can leverage to do take predictive analytics and actually take action with the walk-in freezer or cooler until the operator can get there and actually intervene, as an example. Or it might be we can use AI technology to go out and actually source the best service provider given the location of where that walk-in cooler or freezer is. Okay, so that's what I mean by leveraging AI. What we don't want to do is get into something where, you know, to the person who asked questions point, where you're really going to have to spend, you know, millions of dollars to get that
data processing and bandwidth and
and let's be candid. I mean, the people that are developing that code, rightfully so, are being well compensated. And by the way, that takes a lot of capital, but there's also a higher beta risk to that, right? That they can actually get that platform to a place where it has suitable market uses. We're trying to avoid that, right? So hopefully that answered the question. And if it didn't, to the person that asked it, please feel free to go to our site and contact us. And
yeah, we'll put everybody in touch for sure. Yeah. I think that I think you answered it, because you're not trying to build your own open AI or Bard or anything like that. I mean, it's I don't think that even makes sense, right?
no.
So almost whatever you might be doing, you just piggyback on the things that are happening.
I mean, think of the AI play as like Brian said. I mean, Brian and I have been in and around AWS since from the very beginning, right? Like when they first started offering those services. And what you've seen is it's gotten better and better developed, and then the prices have come down. And what people are doing is they're leveraging that platform. By the way, I might add, both the soft side and the hardware side of that platform. I think the same exact opportunity exists within AI, where creative entrepreneurs can say, wow, I can use this AI with this problem I'm trying to solve, create an application, and create true value. And I think you're going to see a lot of that. We want to find a way to get in the middle of that, because we think there's going to be big value generated.
Yeah, I anecdotally, just real quick, I was toying around with it, and I asked ChatGPT to develop the code, write the website code, and tell me how to do something pretty simple, right? And it came back in 2 minutes and said, okay, you can't do this, but you can do this, and this is how you do it, and you need to go get that. It's like amazing. Like,
Yeah.
I mean, it got me 90% of the way there. I had no idea what to do next, because you still have to be a developer to do it, right? But
Yeah.
I mean, it is mind blowing, just beyond. So I think, just like my little anecdotal example, I leveraged it, because I would have had to go hire somebody, pay him 10 grand just to tell me how to do that, right?
Right. Yeah, and by the way, we've done that. I know Brian and I have laughed about it where, we have a code issue and we've gone out and asked an AI platform and it comes back. It's not perfect, but it's to your point, it's like 90% there. It gives you at least the idea. I think you're going to see a lot of this. The guy that's doing this AI CRM, it intrigued me. It was just more how he was going about it that I shied away a little bit. But the idea of using AI within the CRM, and you're going to see it happen, I guarantee you.
Totally. Yeah.
Yeah, I think is interesting. But that's where I think the value is. And it's funny when you listen to people that manage billions of dollars and they talk about AI, they're all saying the same thing, which is, it's going to be a while before the big winner emerges. But I don't think it's going to be long for some winners to emerge and kind of these leveraging it within applications in the middle market. I think we're going to see that, and we already are seeing it.
We're already seeing it. Yeah, for sure. Yeah. So how's the fundraising going?
Well, it's fun. It's fun to go out and share with people a different perspective. The answer to your question, though, I think it's going well. I mean, our goal was to try to get the fund wrapped up before the year's up, and I think we'll get there. We're tracking. I think what's really interesting is more than just the fundraising, is the interest that we're getting from, like I said, entrepreneurs who want to work with somebody a little bit different than a private equity company, right? Because I mean, you know how it works in the private equity world. Entrepreneur wants a high pre-money valuation, and the private equity guy goes, "I'll give you whatever you want as long as I get my terms," right? And so we go to them, we give them a kind of a fresh perspective. So it's actually been fun. I mean, I don't want to speak for you, Mike, Brian, but I think we're having a ball. It's fun.
No, it's been phenomenal. We have some LPs listening right now in person. So just the pitch, it's a different avenue, as far as to trying to raise money versus being, hands-on with the software and the development of the company. But wearing both hats is a good time.
Yeah, what do you think about, because I know this question is going to come up, and you've answered why you're at 25 instead of 100. And you've got skin in the game, so that is, a great message for other LPs. How do you answer the question about overhead? Like, how can you run a real business on $25 million in nominal or lower management fees? What's your overhead like? You don't have to tell me that, but just I'm sure you've got that question. It says, how do you run a real business at 25 million, right?
I'll answer it. I mean,
Yeah.
Brian and I have had a successful career in technology, and candidly, I'm doing this out of passion and to make money. Meaning, I'm passionate about helping entrepreneurs, but the second part of that is I like to get capital returns rather than current income. So I'm at a place, my partner's at a place where we can put our returns more leveraged to the success of our LPs than to try to take a bunch of income out at the expense of our LPs.
Yeah.
This is for me, and I think I speak for all three of us. This is for us is about a capital play. Meaning, I frankly, I want to make a lot of money by making our LPs a lot of money, because then that means we did what I'm really passionate about, which is we took some entrepreneurs and we helped them be successful, and hopefully they'll pay it forward. Because capitalism is a good thing, and we need to continue to see it prosper. And that starts with young entrepreneurs creating great, successful businesses. And as a result, we get rewarded, which is just fine.
Man, you couldn't be saying it. I couldn't have said that better. I'm so with you. Yeah. We don't need sustenance money. We need, you get rich by inheriting it, investing in real estate, or equity that turns into capital, right?
Yeah, and associating yourself with really good, smart, high integrity individuals. And look, we're not doing this for our ego, saying we're running a big fund or whatever. I'm
Yeah.
dead serious. I'm very passionate. I have young people in my home every week, and we're working on go-to-market plans and, strategies, et cetera. And you know what? For an older guy like me, that keeps me young. So, yeah, some of this is about passion. In fact, a lot of it's about passion.
Yeah. Yeah, that's really good to hear. And thank you for sharing that with everybody. So let's just recap on the ask.
Yeah, so we're in the middle of our raise, 25 million in total. We're on the hook for $1 million ourselves. That's our skin in the game. You heard our unique, tiered approach. We don't have a certain percentage aligned out to friends and family versus family investors. So we're open to hearing from everybody. Our minimum check size is 250 grand. We're giving 8% accretion, and we're only charging 1.5%, and then an 80-20 split after that.
Yeah, and then just to clarify, the 250 ask is a commit, meaning it's drawn.
Drawdown. Yeah.
Yeah.
So you're only paying whatever carry or management fee as it's drawn down, and you're gonna draw down based on whatever you need to deploy, right?
Yeah.
You said something about 13 companies about, and so in 13 companies a year, 13 company that you probably invest in, is it per year or duration of the fund? What do you think?
Yeah, I think our target is to make investments somewhere between 8 to 10. Maybe we'd go as high as 12, depending on how much capital was involved. The maximum we're going to invest in any one company is 2.5 million, or 10% of the fund. But I think it will take us probably through 24 to get that deployed, meaning to make those investments.
Yeah.
And then in terms of a hold period, I think the investors should be thinking probably an average hold of 5 years. There'll be some, that I think will end up selling the company inside of 2 or 3 years. And, there's always going to be one that ends up going a little bit longer.
Yeah.
But I think that's what the expectation should be.
Yeah.
And I think, look, the expectation should be that probably using this unique structure, we're probably going to end up with, between 35 and 50% of the company effectively. We still might have control, but I'm just saying effective ownership. And again, the idea is a minimum return of 25%, obviously higher if we can get there, but we're not going to structure a deal where going in, we know the return is going to be below kind of our minimum threshold. And part of that is that's how we make our money, right? Because
Right,
if
of
we
course.
return,
Yeah.
we get to participate in the ups.
Yeah. And look, you could easily have an outlier that totally exceeds your bogey, right? That
Oh, of
exits
course.
into 24 months, right?
Yeah, I think, candidly, like the company we're just talking about, and you were asking what's on the docket to invest in. So CNR has already invested in Secure Temps, and the LPs that come in will participate in that particular investment. But I fully expect that to end up being an 8 to 10 times our investment return. It's going extremely well. And the one that we have coming up, which by the way, we'll probably end up leveraging a little bit of AI if I had to guess, Brian. But we have a large social platform that we're gonna be launching in October that brings together brands and UGC and influencers together on a platform that's unique compared to the other guys that are out there. And again, I think that one, provided we get through beta successful, I think will be another one that we'll do really well on.
Yeah, so there's a question, so let's just clarify. The 8% pref or accretion is per year, and the 25% target is per year.
Yes.
Yeah,
Yeah,
course.
the 8% is once we do the capital drawdown, yes, annually.
Yeah, sorry, someone was just asking for a clarification on that.
Yeah, no, that's right.
Who's your biggest competitor in this space? Who are you competing for capital with, and how do you differentiate your value to their offerings outside of the three-tier approach?
Look, I think that everybody out there is a competitor because everybody's looking for capital. So let's, in a macro sense, that's true. In a micro sense, you know, I guess we would be competing against the early stage funds out there. But I honestly believe we're differentiated, and the three-tier approach is fine. But I was just on the phone the other day with an early stage venture capital firm, and we're bidding on the deal that Mike's talking about. And yeah, they kind of said to me, well, I don't know if we like your terms. And I'm like, okay, great. But those are my terms.
Yeah,
And
right. Yeah.
well, what does that mean? And I said,
Next.
I'm like, well, no, the question I asked him, and I was serious about it, is like, so who in your investment groups built a software company? Like from the ground, who's actually built one from startup, taken it to market, sold it? Who's actually taken a company public in technology, right? Who's actually invested? And, you know, she had to admit, she goes, no one. I said, great. Then you know what? That's why you're going to want to go with CNR Capital.
Yeah.
Because we actually have done it. And that is our differentiator for the family offices or an investor who's looking to put part of their family office capital into early stage, and they want to de-risk it. And they want to de-risk it both by the way we structured it, but also by having competent managers of the fund who actually know what the software world and the life is like. That's what makes us different. And frankly, most of the VCs I came across when I was an entrepreneur, those guys talk a good game, but they really don't know how to build a software company. The exception are the two companies that I mentioned. Fortunately, they're so big now, I don't have to compete with them for capital because they're really good at what they do. And I think we're going to be really good at what we do.
And to jump in on that, the meeting that I had was with the VC that he's referring to in the conversation. And immediately the CEO of the company was like, her name is Anna. Anna, you know, back up, like, I want to work with them. They've already helped me in with their affiliate program. I've already talked to Brian on the phone. He's already helped me with the scalability. So the CEO was like, you need to back off because I'm working with CNR Capital. It doesn't matter the terms, get it done. So that was great to hear.
Probably not what I'd coach a CEO to do, but
Yeah, but maybe a little. Yeah.
But I mean, you get the point. I mean, that really is the differentiator. And we've talked in our fundraising and talking to some of the family offices, they've all kind of come back to us. That's a really unique approach because we haven't seen that in the marketplace.
Yeah.
I'm sure it exists because, like I said, Scott does it at OpenView, and Peter Smith and those guys down at JMI have done a great job doing that. So I know there are companies that do it, but it is unique.
Look, I think that it bodes well in your example that you have been able to dodge all the bullets, take a few hits, learn from them, build a company, actually have revenue and business and sell it. That cycle is unusual. You know, as much as all the VCs say they've done it one way or another, there's many of them that have not, right? They've flushed more than they've succeeded. So, and I'm not anti-VC. I'm just in the same boat as you. I've had spectacular disasters and some great successes and learned from them. And those learnings, I said I'd never say that word again. Those learnings were, instructive, right? And it's just stuff that you wouldn't otherwise have known had you not done it, right?
I mean, I think I've over the years I've run, I guess, 4 or 5 software companies. I've run an 8-bit semiconductor company. I've done turnarounds of technology companies where the bank was going to foreclose, and you learn a lot of this stuff. And what I'd like to do, you know, for those on the call that don't know who I am, I mean, look, I'm 60 years old. I want to take the next 10 years and share what I've learned and pay it forward to the next generation of entrepreneurs.
Yeah.
And, you know, if we can do that, get a great return as a team and help these entrepreneurs do well, I do think that's something that's unique, and I'd like to see more people do it.
And it's great for the country,
Yeah, exactly.
by the way,
See
right?
more people do it.
Yeah, totally agree. Well, super appreciate you guys coming back again, and we'll make sure everybody gets in touch and directly and so they can communicate and chat with you and have discussions if they're interested in investing and I said,
I see
yeah,
the
please go ahead. Yeah.
chat in the Q&A. So are you sending our emails or the website?
Yeah, we're gonna make sure I sent the email address for you,
Right.
and then we'll make sure everybody gets in touch. There's a couple questions here. Let me see. For the LPs after the initial investment, what are the recurring costs? It's just the carry, right?
The 1.5% management fee.
The and the carry, right? Yeah.
Yes.
Okay. Yeah, let's be just great. Well, listen, thank you all for your questions, by the way, from the audience, and thank you both for being here. You guys want to just have a closing statement?
I just want to thank you and I want to thank the folks that spent time today listening to our story. And we would love to have you participate with us. And so just thank you for your time and hope to talk to you soon.
Yeah, we'll make sure everybody gets in touch.
Same
Thank
for me. Thank you guys very much. We all appreciate it.
Super. Thanks, Michael. Steve, Brian, thank
Take
you.
care.
See you.
Take care.
Thanks, guys.